A single U.S. court ruling just changed how firearm rights may be interpreted across multiple states, and the people celebrating it are. When you were working, taxes handled themselves. Money came out of every paycheck. The system kept moving even when you were not thinking about it. The moment you retire, that system disappears. Pension checks may not withhold enough. IRA withdrawals may have no withholding at all. Social Security can become taxable. Medicare premiums can jump because of income you created 2 years earlier. And the worst part is this: nobody explains what replaces it. So retirees keep losing money quietly. Not because they cheated, not because they were careless, because the rules changed and nobody told them. Today, I'm giving you the complete list. 10 IRS rules you must follow immediately if you want to protect your retirement income and avoid expensive mistakes most seniors never see coming. This video is for educational purposes only. Tax rules can change and your situation may be different. Before making a tax move, consult a qualified tax professional who can review your income, filing status, and retirement accounts. Number 1. Estimated tax payments. This is the first rule that shocks new retirees. The IRS still wants tax paid during the year, not at the end. If you do not have enough withheld from pensions, annuities, IRA withdrawals, dividends, interest, or capital gains, the IRS expects quarterly estimated payments. Why is this a problem? Because many retirees think, I'll just settle up in April. Stop. This is where people lose money. The IRS can charge an underpayment penalty even if you pay the full balance with your return. If you ignore it, you can get a penalty notice and interest keeps adding up. The basic protection rule is simple. Usually, you want to owe less than $1,000 at filing or pay in at least 90% of this year's tax or 100% of last year's tax. If your AGI was over $150,000, that prior year's safe harbor becomes 110%. What should you do? Write this down. Check your withholding now, then compare it to your last tax return. If you are short, set up estimated payments for April, June, September, and January, or increase withholding from pension or Social Security. Real example. If last year's total tax was $8,000, paying in $8,000 during the year can generally avoid the penalty. But if your AGI was above $150,000, you may need $8,800 instead. Most retirees miss this because no employer is fixing it for them anymore. Number 2. Social Security tax withholding through Form W-4V. Here's the part most retirees don't realize. Social Security does not automatically withhold federal income tax the way a paycheck used to. The IRS allows withholding, but you usually must ask for it. Why is this a problem? Because many retirees discover too late that their benefits were taxable, but nothing was held back all year. Then, the bill lands at filing time. If you ignore this, you can end up writing a big check in April, and, if you underpaid enough during the year, you could also face an underpayment penalty. What should you do? Use Form W-4V or contact Social Security and choose withholding of 7%, 10%, 12%, or 22% of your monthly benefit. This is not optional if you know your other income will push part of your benefit into taxable territory. Real example. If your monthly Social Security benefit is $2,400 and you elect 10% withholding, that sends $240 a month to taxes, or $2,880 over a year. That one step can keep a surprise tax bill from blindsiding your budget. Nobody tells you this because retirees assume withholding is automatic. Number 3. The Provisional Income Formula. This one catches people every single year. Provisional income means 1/2 of your Social Security benefits, plus your other income, plus tax-exempt interest. That formula decides whether your Social Security becomes taxable. Why is this such a problem? Because many retirees think Social Security is tax-free. Then they add a pension, part-time work, IRA withdrawals, interest, or municipal bond income, and suddenly the formula flips against them. If you ignore this, up to 50% or even up to 85% of your Social Security benefits can become taxable. This is where the IRS penalizes you indirectly. Your tax bill rises even though your benefit did not. What should you do? Run the formula before taking extra withdrawals. If you are near the thresholds, one extra move can push you over. The thresholds are still low. For many single filers, taxability starts above $25,000, and for married filing jointly, above $32,000. Above $34,000 single or $44,000 joint, Up to 85% of benefits may be taxable. Real example. A married couple receives $36,000 in Social Security and $30,000 from a pension. Half of Social Security is $18,000. Add the $30,000 pension, and their provisional income is $48,000. That is above the $44,000 joint threshold, so up to 85% of their Social Security can become taxable. Most retirees miss this because the trigger is not the benefit itself, it is the formula behind it. Number 4. Senior deductions and tax benefits. Write this down. Many retirees overpay simply because they never claim the deductions they already earned by age. The IRS gives older taxpayers extra deduction rules, but you must know which ones apply. Why is this a problem? Because many seniors hear standard deduction and stop there. They do not realize there is an additional standard deduction for being age 65 or older, and now there is also an enhanced deduction for seniors for eligible years. If you ignore this, you may report more taxable income than necessary and give away money that should stay in your retirement account. What should you do? Compare your filing status, age, and income to the current deduction rules every year. For tax year 2025 returns filed in 2026, the standard deduction is $31,500 for married filing jointly and $15,750 for single filers. The age-based additional standard deduction is $1,600 per qualifying spouse or $2,000 if you are unmarried and not a surviving spouse. On top of that, eligible taxpayers age 65 and older may claim an additional $6,000 per person from 2025 through 2028, with phase-outs above $75,000 single and $150,000 joint. Real example. A married couple, both over 65, could have a $31,500 standard deduction, plus $3,200 for age, plus up to $12,000 more from the enhanced senior deduction if eligible. That is $46,700 in deductions before itemizing anything. This is where people lose money because they think retirement means fewer benefits, when sometimes the opposite is true. Number 5. Required Minimum Distributions, or RMDs. An RMD is the minimum amount the IRS forces you to withdraw from certain retirement accounts each year. What changed? For many retirees now, the starting age is 73. For people born on or after January 1st, 1960, the applicable age is 75. Why is this a problem? Because the IRS does not send a warning before the deadline. The money can sit there looking safe, but once your RMD year begins, that account becomes a tax deadline. If you ignore it, the penalty is brutal. 25% of the amount you should have taken, reduced to 10% if corrected within 2 years. This is not optional. What should you do? Check your birth year, check each account, and decide whether to take the first RMD in the year you hit the trigger age or delay it until April 1st of the next year. But be careful. If you delay the first one, you may have 2 taxable RMDs in the same calendar year. Real example. If your first RMD should have been $12,000 and you miss it entirely, the penalty can be $3,000. If corrected in time, it may drop to $1,200, but that is still real money. And remember, Roth IRAs owned by you are generally not subject to lifetime RMDs, which is why planning ahead matters. Number 6. Qualified Charitable Distributions, or QCDs. This is one of the best rules most retirees never use. A QCD lets you send money directly from an IRA to a qualified charity. Why is this powerful? Because the distribution can be excluded from income instead of showing up as taxable income and then hoping a deduction helps later. That matters even more now that so many retirees use the standard deduction and never itemize. If you ignore this rule, you may donate with after-tax dollars when you could have lowered taxable income instead. What should you do? If you are at least 70 and a half, ask your IRA custodian to send the money directly to the charity. Do not withdraw it first and then write your own check. That breaks the strategy. A QCD can also count toward your RMD. For 2026, the annual QCD exclusion limit is $111,000. Real example. If your RMD is $15,000 and you plan to give $10,000 to charity anyway, a properly done $10,000 QCD can satisfy that part of your RMD without adding that $10,000 to taxable income. That lower income can also help with Social Security taxation and Medicare premiums. Here's the part most retirees don't realize. One smart charitable move can help three tax problems at once. Number 7. Roth conversions during gap years. Gap years are the years after work slows down, but before RMDs and larger retirement income streams hit hard. This is where smart retirees can move money from a traditional IRA to a Roth IRA at a lower tax rate. What does the IRS expect? If you convert, the untaxed amount you move becomes taxable that year, and it must be reported correctly on Form 8606. Why is this a problem? Because many retirees wait too long. Then RMDs, Social Security, and investment income stack on top of each other and push them into a higher bracket later. If you ignore this, you may save tax this year, but pay much more over the next 10 or 15 years. What should you do? Look for low-income years after retirement and before forced withdrawals. Convert only enough to fill a tax bracket instead of jumping into a much higher one. And remember this, a Roth conversion cannot be undone. Real example, if you convert $40,000 in a year when you are in the 12% bracket, the federal tax on that move may be far lower than waiting until future RMDs push you into 22%. That bracket difference alone can mean thousands of dollars over time. Most retirees miss this because they focus only on this year's tax return, not the lifetime tax bill. Number 8. IRMA, the Medicare surcharge trap. IRMA stands for Income-Related Monthly Adjustment Amount. In plain English, it means Medicare gets more expensive when your income crosses certain lines. Why is this such a problem? Because the hit shows up later. For 2026 premiums, the standard Part B premium is $202.90 a month. But if your income is high enough, the premium jumps. And the decision is based on prior tax return data, so a move you made earlier can raise your premium now. If you ignore this, a Roth conversion, a large capital gain, or a big IRA withdrawal can trigger hundreds or even thousands in extra Medicare costs. What should you do? Before creating extra income, check the IRMA brackets. For 2026, higher Part B premiums begin above $109,000 for single filers and above $218,000 for married couples filing jointly. Real example, if a married couple lands at $230,000 MAGI, each spouse moves above the first IRMA line. Their Part B premium becomes $284.10 each instead of $202.90. That is an extra $81.20 per person per month, or $1,948.80 a year for the couple, before any Part D surcharge. Stop. This is where people lose money because they celebrate a tax move and do not notice the Medicare bill 2 years later. If income later drops because of retirement or another life-changing event, SSA 44 can be used to ask for a lower IRMA. Number 9. Your IRS address and every notice they send. This sounds small. It is not. The IRS expects your mailing address to be current because notices, refund checks, identity letters, and payment demands all go there. Why is this a problem? Because retirement often comes with a move, downsizing, relocating to another state, splitting time between homes. If you ignore an address change, the IRS can keep mailing old notices to an old address while penalties and interest keep growing. What should you do? If you move before filing, use the new address on the return. If you move after filing, notify the post office and also notify the IRS directly. You can use Form 8822, write to them, or call. The IRS says address changes can take 4 to 6 weeks to process. Real example. Imagine you moved in May, never updated the IRS, and a notice about a $2,300 balance went to your old home in July. You do not respond because you never saw it. By the time you discover it, more interest and penalties may already be attached. This is where the IRS penalizes people for paperwork, not fraud. Most retirees miss this because they think mail forwarding handles everything. It does not. Number 10. Standard deduction versus itemized deduction. This is the final rule, and it decides whether you legally lower your tax bill or leave savings on the table. The IRS expects you to choose the method that applies to you each year. Standard deduction is the flat amount. Itemizing means listing certain deductible expenses on Schedule A. Why is this a problem? Because many retirees pick one method out of habit. They do not run the numbers. If you ignore this, you may miss deductions for medical and dental costs, mortgage interest, state and local taxes, property taxes, gifts to charity, disaster losses, and more. What should you do? Compare both methods every single year, especially after retirement changes your mortgage, health costs, giving, and state taxes. Here's the part most retirees don't realize. One year you may take the standard deduction, and the next year itemizing may win because of a surgery, large dental bill, or bunching charitable gifts. Real example. Suppose your married standard deduction is $31,500, but your itemized total adds up to $35,800 because of medical expenses, property taxes, mortgage interest, and charity. If you fail to itemize, you leave $4,300 of deductions unused. In a 12% bracket, that is over $500 in extra federal tax. Nobody tells you this because the wrong choice does not feel like a mistake, but it is. Here are all 10 in order. Estimated tax payments, Social Security withholding with W-4V, the Provisional Income Formula, senior deductions and tax benefits, RMD rules, QCDs, Roth conversions in gap years, IRMA Medicare surcharges, keeping your IRS address current, and choosing standard versus itemized deductions the right way. The IRS expects you to know all of this, but nobody tells you, and that is why so many good people lose money in retirement without understanding where it went. Which of these did you not know? Comment below, because the next video I'm making could save you thousands. And send this to someone retiring this year, because one missed IRS rule can quietly damage an entire retirement budget.